They called me the father of growth investing. I'm Philip Fisher. While Benjamin Graham taught the world to look for bargains in the market, I taught them something different. To find businesses so good, so enduring, that even if you pay a fair price, you win over time. Let me share with you the principles from my book, Common Stocks and Uncommon Profits Ideas, that still guide the best investors in 2025. My path to investing wasn't straightforward. I studied chemistry, I studied business, I even worked for a bank. But what fascinated me most wasn't numbers. It was people, management, innovation, the character of a business. I believe the secret to great investing was unhidden in balance sheets. It was in understanding how companies truly operated. And that's how I developed my philosophy of growth investing. But first, let's set the stage. The time was the 1950s and 1960s. Wall Street was changing fast. Investors were looking for more than just safe, stable companies. They wanted growth. They wanted innovation. And that's where my book came along. Common Stocks and Uncommon Profits wasn't just a book, it was a movement. It showed investors a new way to think about the market, a way that emphasized the importance of the quality of a company and its management. In my book, I outlined what became known as my 15 points to look for in a common stock. Not technical tricks, not short-term signals, but questions. Does the company have products with long-term growth potential? Does management have integrity and vision? Is there a strong research and development culture? Are profit margins high and protected from competition? I wasn't buying stocks. I was buying businesses and asking, can this company grow and compound for decades? My 15 points provided a framework for evaluating companies, but they also sparked controversy. Some thought my approach was too subjective, too focused on qualitative factors. But I knew that the true keys to a company's success often lay beneath the surface of the numbers. For example, in Chapter 6, I discussed the importance of a company's field of activity. What industry does it operate in? How big is the market? Is it growing or shrinking? These are crucial questions because an industry's overall health significantly affects each company within it. Then there's Chapter 10, dedicated to earning power. Here I talk about the different ways to measure a company's profitability. But more importantly, I emphasize how to spot sustainable and increasing earnings, which indicate a company's true strength and growth potential. I also cover what I call the discipline of selling short-lived profits. I urge investors to avoid companies with one-off, temporary boosts to their profits. You want earnings that are steadily growing year after year, not just artificially inflated for the short term. In Chapter 12, I focus on a company's financial position. It's essential to understand how much debt a company has, its cash position, and overall financial health. These factors help you assess the company's stability and ability to weather any economic storms. And finally, in Chapter 14, I address dividends. In an era when many investors consider dividends the primary measure of a company's success, I urge a more balanced perspective. Yes, dividends are important, but they shouldn't be the sole focus. I advocate for companies that reinvest their profits back into the business, driving long-term growth rather than just paying out dividends. But one of my favorite methods was what I called scuttlebutt. It meant talking to everyone you could: suppliers, competitors, employees, even former workers. Why? Because annual reports don't tell you everything. But people close to the business often reveal the truth, whether a company is innovative, trustworthy, and worth owning. I used scuttlebutt to uncover opportunities most analysts never saw. In 2022, my book was added to the National Film Registry by the Library of Congress for being culturally, historically, or aesthetically significant. That's why you'll see some of the old footage in this video. It's part of our heritage. In the decades since I wrote Common Stocks and Uncommon Profits, my approach has stood the test of time. Yes, markets evolve, but the core principles of evaluating a business remain timeless. The key, as I've always believed, is to keep these principles simple. Don't overcomplicate things. Just focus on finding great businesses and backing their long-term potential. That means asking tough questions, digging deep into a company's financials and management, And most importantly, having the patience to let compounding work its magic. Compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it. I want to leave you with a final thought. When it comes to investing, it's not just about making money. It's about finding great companies and supporting their long-term success. So ask yourself, what kind of investor do you want to be? Someone who chases quick profits or someone who builds wealth by owning outstanding companies through the years? The choice, as always, is yours. If my story gave you new perspective, hit that like button. It helps this channel reach more serious investors like you. And subscribe because in the next video, we'll explore another market legend and the wisdom hidden in their journey. Now tell me, would you rather own a few great companies for decades or trade many stocks for quick gains? Share your answer in the comments. I'm Philip Fisher, and I remind you, great businesses, held with patience, create great fortunes.